Okay, well, thanks very much. For those of you who don't know me, I'm Greg Waller, Vice President of Investor Relations. Got to think about what we wanted to cover here briefly this afternoon. Welcome to our Investor Day, of course. Thanks very much for coming here. We've got a great weather day for people to travel from New York. A number of people have. Just a brief overview of the agenda. I'm not going to go into the details of it, but we have allocated a fair bit of time to our energy business. Ray Repus is going to speak about that at the end of the afternoon, so I think you certainly want to stay around to the end of the day. Forward-looking information slides I should draw your attention to. We're just going to cover this once. Some of the things we say today will be forward-looking in nature, and there are risks and uncertainties, of course, in our business you need to be aware of, and those are more fully disclosed in our filings available on EDGAR and SEDAR. And, I know the other thing. There is in front of you a survey form on the afternoon's presentation. We highly value your feedback, so certainly no need to do it now. Of course, we'd like you to do it at the end of the day after you've seen what we have to present. And we have a gift for you at the end of the day as well, and that's your incentive for getting a survey form into us as well. So we're doing that a little differently this year to try and increase the response rate. And with that, Laurie, am I missing anything? I'm not. Okay. I'll tell you, I would like to introduce Laura Rosali. She joined our team. She's not speaking today, but she joined our team in Investor Relations earlier this year. And she's certainly available to talk to during the day to get to know. And with that, I'm going to turn it over to Don Lindsay, our President and CEO, to give you a bit of an overview on strategy.
Thank you very much, Greg, and welcome to all of you this afternoon to attend our Investor Relations Day and Annual Affair. And I'm going to go through the normal subjects you expect, but I'm really looking forward to the questions, which is usually the most valuable. And to start with, as I do each year, just a review of the management changes in the last 12 months. If you think about it, if we have roughly 32 officers of the company, and if you had a 10 or 12% turnover rate, then in any given year you're going to have 3 to 5 new people. And so this year, the first one I wanted to highlight is Ian Kilgar has been appointed to the Chief Operating Officer role, Executive Vice President, Chief Operating Officer, and this is in recognition of the tremendous job that Ian's done with the coal business. I think you've seen the results over the last year or two since Ian took over, actually in February of 2010. Did I get that right? Or was it 2011? 2010. So he's now got the responsibilities for coal, copper, and zinc. The energy division continues to report to me at this time, as does project development. And then Ron Vance is going to be retiring next year, end of February. Ron has been a tremendous contributor to Teck and its overall strategy into getting us to the strong position that we're in today. He's been with us for the last 8 years, and he is doing, as a number of other executives that we've had, is doing a phased form of retirement, where as of May 1st last year, he went to halftime while we were in recruiting phase to find a successor, and so he's working through an overlap period right now, which just gives me twice as much wisdom to draw upon as we look at key decisions in investing our capital. And I'm sure even after formal retirement, Ron will stay in close touch, and we certainly appreciate that. And to introduce successor, Andrew Golding, and maybe I'll ask Andrew to stand up because a number of people wouldn't have met him. There he is at the back. Andrew joined us a couple of months ago and has an incredible range and depth of experience, having started in South Africa at Goldfields and gone through that phase when Goldfields was under hostile attack from the Anglo/Minorco group, and then ended up with Billiton during the merger with BHP Billiton, and he worked in that group that went on to do great things, such as from Brian Gilbertson to Marius Kloppers and Mick Davis, and he was right in amongst that group of executives as they developed their vision. He was in charge of the integration of BHP and Billiton, and then ended up in Australia and worked in several parts of BHP and saw a lot of their acquisition activity from the inside, including the largest proposal in our industry ever when BHP and Rio Tinto were possibly going to come together. So he has just a great range of experience. I can ask him about any commodity, any country, geopolitical risk, technical issues, and so it's just a great source of advice for myself and the board, and execution capability, integration capability. So we welcome Andrew to joining the team. And we've kept him busy from day one. Actually, he arrived in town on a Friday night. Saturday morning, I called him. I said, don't come to the office on Monday. You're getting on a plane. And we took him to Line Creek just to show him the first operation on his first day in the selenium plant and the rest of it. Also, during the year, Roger Higgins retired, and we had all sorts of choices from outside. I have to say, this has been a tremendous year because of all the changes at the senior companies around the world. We had a lot of people who were looking for a move and looking to come to a company that was still in growth mode. And notwithstanding that, we decided to go within, and Dale Andrus has been promoted to Senior Vice President Copper. And Dale's been with us for a couple of decades or so, and has a wide range of experience, both underground and open pit, and has certainly unleashed a lot of energy on our copper business, and in South America and QB in particular. During the year, Dave Parker retired, and so Mark Edwards is his successor as Vice President, Community and Government Relations. Mark, again, has been with us for a long time and has very detailed exposure to a range of community and sustainability issues, and reports to Marcia Smith, and certainly hit the ground running in that position. And last but not least, Dean Windsor has been appointed Vice President, Human Resources, and he's been in that position almost a full year now. But I can tell you the energy that he's brought to it in terms of working with his business partners and really helping them resolve their issues and recruit stronger teams, it's just been terrific. So those are the management changes over the course of the year, and we believe we have quite a strong team, a lot of depth, and working very well together. So even though it's in a downturn and sometimes people get tempted by other situations, we've been very lucky that it's working in reverse and coming our way. So turning to a review of our strategy, and I think you all know this, but just to repeat, we are committed to diversification, and we think that's it's not diversification from diversify the portfolio risk, but it's really, when it comes to capital allocation, that we'd like to be able to look at all sorts of opportunities and choose the best place for our capital from a risk-reward point of view. A key part of that, and I really believe this in the global mining industry, is assessing geopolitical risk. We always start with the ore body, the resource, the geology is what we're all about, but a close second is geopolitical risk. And I think as we've seen the world evolve over the last 20 or 30 years, this is one of the key skills in the business. We spend a lot of time on it. Currently, our portfolio is quite conservative, as you can tell. Mostly, from an operations point of view, we're in the Americas. But even within that, there are certain countries that we've clearly avoided. One point of note, there are evolving situations. There are some countries we may not be in now, and we maybe have even said publicly, which I probably shouldn't, but should be careful about not going to. But countries do evolve, and if you went back 25 years ago, you might have been hesitant to go into Chile, and 20 years or so, you might have been hesitant to go into Peru. And even 5 to 10 years ago, you might have been hesitant to go into Colombia, for example. And I'm not about to invest a lot in Colombia, but I use it as an example that, 10 years ago it was number one on the kidnapping list, and today it's not in the top 10. And the number one is actually Mexico. And we were always involved in Mexico over the years. So you really do have to assess things carefully and looking out, and it comes to two different factors. First and foremost is safety of our people. If we can't guarantee that, then we're just not going to go there. And secondly, recovery of capital. And one of the expressions that I use around the office is that you can be blinded by grade. And there are many situations geologically around the world where the grades are just fantastic, and you'd love to be able to mine that compared to 0.2 or 0.3 at Highland Valley. But my belief, having watched these things for a long time, is that often If they show you a PowerPoint presentation saying you've got a 40-year mine life, the reality is you've got 3, and those are the 3 years you're putting money in, and then the rules will change on you, and it doesn't matter what the grade is. It's tough to get your capital back at all, let alone get a return. So we're very, very careful about that. Currently, our business unit is, I wouldn't call it overweighted, but heavily weighted towards steelmaking coal. But I would point out that if you went back 4 or 5 years ago, people thought of us as a copper company, not a coal company. And if you went back 2 or 3 years before that, people thought of us as a zinc company. If you look forward 5 years, copper is actually going to grow faster than coal and will become our largest business unit again. And even if you look at the operating earnings, because the coal price is down proportionally more than copper, you'll see that copper actually, in some quarters in the last year, has been bigger than coal. So, and then if you look forward 10 years, the energy division could be the largest division at that point, just depending on how commodity prices go. But the way we think of it is that in terms of scope of each of the businesses, they're not that different in size. We do have a large zinc business, but the zinc price is fairly low. If zinc was $1.50, you'd all be looking and say, well, they've got a big zinc business, and it will be $1.50 at some point in the future. So we think it's probably more balanced than any one quarter's results show, and that's just an observation. We're quite committed to long life assets. The Fort Hills decision involves a 50-year asset. In our coal business, we have in some cases 100-year assets. QB2 is a 50-year asset, and other things that we've looked at from an acquisition point of view have been very, very long life. And the reason for that, and I mentioned this on the quarterly call, is related to a ratio we call mine life to payback. And whether it's an acquisition or whether it's a construction decision, for some of these large capital decisions, the payback period, couldn't be seven or 8 years, depending what commodity prices would be. If you have a mine life, as so often happens in the gold industry, for example, of only 10 or 12 years, and you happen to have a period of very low commodity prices, you may not have a chance to get much of a return. If you have a mine life of 50 years and your payback is 7 or 8 years, then you've got a mine life to payback of 6 times plus, then the odds of back calculating your IRR on that one and having a very good number are very high. I've always said that people do all this hard work on calculating an NAV or an IRR, and the only thing you know for sure when you're finished is that it's wrong, because there's assumptions that you've made, and the assumptions in real life will turn out to be different. We do know that commodities, whether it be zinc or copper or coal or oil, they're cyclical, and that you'll make all your capital back in 2 or 3 good years. You just don't know when those 2 or 3 good years are going to be. But if you have a 50-year mine life, you can be confident that you'll get those 2 or 3 good years several times, and then that means that you're going to end up with a good return. So long life is really important to us. Low half of the cost curve, we'd like to say lower quartile of the cost curve if we could, but I think you have to be realistic and practical. We will look at opportunities from time to time that are higher than that, and of course we ourselves had forwarding, which was top of the 3rd quartile, if not in fact the bottom of the 4th quartile. But we were able to move it from roughly the 80th percentile on the cost curve down to roughly a 40th percentile. So we use that as a target. If we can get the middle of the cost curve, then you know that you're going to survive throughout the cycle. Commodity prices rarely go to the 50th percentile. They often go to the 90th or 85th percentile. And so we don't want to be there. But some people do have that strategy of having a high cost and a high leverage to commodity price rallies, and that can work too. That isn't our strategy. We'd like to have a long-term quality position. I talked about why we diversify in the opening comments. Low-risk jurisdictions, I think I've covered that as well. And on balance, it's always a risk-reward decision. And within that, you're going to have to look at operating risk, NGO risk, community risk, and there's a whole bunch of risks that can make a real difference to your investment performance. In terms of markets and customers, over time we've evolved more towards Asia. Asia is Asia broadly defined. It's not just China. We are selling a lot more to China now than we did pre-CIC. For example, before CIC in coal, we only sold to one customer, Baosteel, and that was only about 200 to 250,000 tons a year. Today, we're more like 6 or 7 million tons to China with about a dozen customers, 6 or 7 of which are becoming quite strong relationships. But you'll hear more about that from the coal guys. And we've reduced the weighting to Europe. And that was quite a deliberate decision after the global financial crisis, where several of the key customers there reneged on their contracts. And we had some pretty tough discussions with 5 of them. 3 of those actually then wrote us a check to make up the margin over the part of the tonnage that they didn't take. So that was good. We restored them to full tonnage. The other 2 didn't, and we didn't. And so we've shifted that to a stronger market, we believe. And I should say, we don't intend to get overweight to China in terms of actual customer volume. We're also dependent in this industry on China anyway. They set the marginal price, they buy the marginal ton of everything. So we don't want to also have customer risk within that. So 25% is a reasonable number. It might go higher in a quarter or so, depending on conditions, but we watch that fairly carefully. And I should say, the work that we put into establishing some very strong relationships with China, not just CIC, which is the Chinese government as a 17% shareholder, and as most of you will be aware, the original partner that we had there that I signed the deal with is now the finance minister of the country. But we also have good relationships with the Central Party School, and I made my first address to the Central Party School in September. And fascinating to hear the questions that they ask. And these are people that are deputy ministers and mayors of large cities, and they have to go and spend 3 months at the school every 5 years. It's sort of part of the requirement to be at senior level of the Communist Party. And what they learn there is how Western companies are handling certain issues. In our case, we've become a strategic partner of the school to help teach them about sustainability and community engagement, because we're ranked quite highly in those areas. Corporate Knights ranks us as the most sustainable company in Canada and most sustainable mining company in the world. So they ask us for effectively input into what their curriculum will be, and we've brought 3 groups of 10 of their quote cadres or students, and these are future leaders or sometimes current leaders, to our sites and see our coal mines and copper mine and go fishing in the tailings pond and all those things. And so one belief I have, and I'm a little bit off topic here, is that you will see at a much faster pace than people expect real movement on sustainability practices in China. This chart is another way of trying to describe what I've been talking about for a couple of years in terms of China's growth. We constantly see in the media and also in some analyst reports real worries about China's GDP growth going down to 7%. And my point is the way the math works is it's a percent on a big, large denominator, China being the second largest economy in the world now and headed to be the largest. And so the reality is the incremental dollar value of GDP growth is still very high. And mathematically, growth will have to go down to 6 and then 5. That's just the numbers it has to be. And so we shouldn't be troubled by percent. We don't care about percent. We care about tons, and the tons are still very big and in many cases still going up. On one morning 2 months ago, they announced record copper imports, record coal imports, record iron ore imports, record soybean imports. So still very big numbers there. It's not as if the world has just stopped. This is a chart that's just another form of demonstrating that. And one of the underlying themes that we look at as we think about how to invest our capital is urbanization. And people have talked about urbanization in China, and it's clearly been an incredible driving force the last 20 years, and it will continue for the next 20 years. There are 300 million more people to go according to formal policy. And Li Keqiang, the premier, talks about urbanization in almost every speech he gives. But it isn't just there. It's also in emerging markets generally everywhere. And if you look at what OECD publishes, or a more neutral party like McKinsey, they see this urbanization trend carrying on for quite some time. And with urbanization comes big investment in infrastructure, which is driving demand for commodities. All of this is being balanced by just how difficult it is to bring supply on. And it's not just about permitting, it's about ore bodies having lower grade, it's about workforce productivity, it's about difficult terrain, all sorts of challenges. It is not easy. One of the points in this slide is that China, notwithstanding all the urbanization that has happened, still ranks 129th in the world. We've experienced 2, probably 3 full decades of incredible growth in China, but that doesn't mean that it just ends one day. And one point that this chart is making is that currently, notwithstanding all that growth, China's GDP is still only 20% of the U.S.'s on a per capita basis. Now, we don't, it says per capita, it's per person. But now, we don't believe for a second that it's going to anytime soon become equal per capita with the U.S. You just look at the laws, and they have 1.3 billion people, the U.S. has 3 million. So that would be, I think, an unrealistic expectation. But it can go a lot further than 20%, and we do believe that that will be an important driver in the future. This is a new slide, and what it shows is the growth that occurred after the country reached that 20% threshold of U.S. GDP per capita. And so Japan, for example, was at, I guess, 21% of U.S. GDP per capita. And then the next 20 years, it averaged 9.2%. And you see the numbers there for Singapore, Taiwan, Korea, and China. And so to the extent that people think it's going to all of a sudden drop down to 1.5%, 2%, or 3% like we see in the U.S. or Western Europe and so on, we believe that is unlikely. And again, remembering how big the base is, even if these numbers turn out to be an inaccurate forecast and it's only 6 or 5%, the base is so big that these are very big numbers. Okay, turning to our steelmaking coal business unit. And once again, we are constantly calling it steelmaking because there is a lot of noise about the word coal, and it's mostly related to thermal coal, and we want to make sure that people understand that thermal coal is not our business. Steel, which is actually very important for most of the environmental activities that people think of, mass transit to move transportation of people with lower carbon footprints, of course, involves an enormous amount of steel, as do windmills, solar panel, the rest of it. We're growing to maximize the value of our resources. Recall that we have a very large resource. We believe it's the second best resource in the world, about 6 billion tons, most of which is high quality hard coking coal. There will be challenges related to water, for example, and selenium, and other issues, but when we compare our set of challenges against what we see happening in Mozambique or Russia, Mongolia, other new sources of large supply of coal, or even the challenges that Australia has gone through that caused their costs per ton to double in less than a 5-year period, we think our position looks reasonable. Ian and his team have really been focused, and while others may have had their costs rise faster, we've been able to sort of hold the line on a reasonable basis, and that has resulted in us having the most profitable steelmaking coal business in the industry. Of course, we shouldn't have, because we're not nearly the size and scope of the BHP Mitsubishi Alliance business, and they will, one day and maybe soon have a more profitable business as they should. But at least for last year and this year, we've had the number 1 ranking in that. We have, I think, as you all know, 6 operations currently, and 1 on the verge, ready to go when we feel it's time, and that's Quintet, and you'll hear more about that later on. But one of the things that I'm always conscious of, and I'm hoping that other CEOs in the industry are also conscious of, though I'm skeptical at times, but you always make more money on price than you do in volume in this business. Always. And well, I obviously am restricted from having those conversations with other CEOs. You're not. So anything you can do to remind people, that would be terrific. Turning to copper, we have increased copper production over the last number of years. We hit our peak in the second half of last year when we had a target of hitting 400,000 tons annualized, which we did for the last 6 months, so we were very pleased with that. But we also knew that that would be the peak for a while, because we have two graciously called mature operations, being current QB and Duck Pond, that are in their last years. And with most operations in the mining industry, as you get to your last years, grades decline and costs go up, and it gets a lot tougher, and we are certainly seeing that. But meanwhile, some of the investments that we've made are really paying off, or are about to pay off. Highland Valley, I think a number of you got to tour it in September, and the mill optimization project is just about finished. And that will increase throughput and also increase recovery. And we have combined with that a resource development project that there's a lot more material there. In fact, much of it at higher grade than what we currently mine. So this positions Highland Valley to be just core to our portfolio for still literally decades to come. When I started in 2005, it was scheduled to close in 2008. And now I have different reports that show it'll be running into 2040 something, and wouldn't be surprised if it was a lot longer. Carmen Andacollo, as you recall, we were able to build the concentrator and quadruple production there for $430 million to get an 80,000 ton a year concentrator. And that capital was very fast payback, and probably one of the most efficient capital allocations that we've made. So we're very pleased with the operation, and I think Royal Gold has done well also. It does have its challenges from time to time with hardness and others, but we've found solutions so far. Antamina's has 30% expansion last year, so you can see that a lot of new capital is being put into this part of the copper business. Just like in coal, we've just finished a whole phase of investment where we have new shovels, new trucks, mill upgrades, and the like. So even though some of these assets have been running for quite a while, they do have the benefit of recent high levels of sustaining capital. And then QB is a whole other subject where we have the current mine depleting, and we're delayed on the permitting. QB, if you like, is our most challenging asset in the portfolio at the moment, but it also has huge potential to run for 50 years and be expanded 2 or 3 times during that, so we carry on. One point that we've made in other presentations is that we are convinced that the cost of producing copper is being understated. And there are a number of reports that have come out recently. There's one by Bernstein that I think is pretty good, looking at the cost curve. Often the cost curves are put together using a company-wide cost of production. And what that misses is just how much tonnage is at the high end of the cost curve, and at $3 or better, that's really supporting the copper price. So for example, in Teck's case, if we say our average cost of production is $1.70, we have a range of everything from Antamina 20 cents to QB, which was over $3 at one point. We've got it down to $2.50 something. And so if you just publish the one number, it looks like all is well, but it doesn't show that a serious amount of tonnage could come off if prices dropped below $3. And this is probably the case it is the case in all sorts of company reports. And so I think you have to look at it at the next sort of granular level of detail. And then what we've found just doing our own studies is that on average the commodity consultants have been understating cash costs versus actual reported costs of the top 10 companies, which is what you're seeing here, by as much as by on average about 20%. So if you thought that $2.50 was a long-term price and your costs are off by 20%, then maybe that takes it to $3. And then, of course, you've got to build in the whole sustaining capital issue, and there's been a lot of good work done on that in the gold industry, which I think could be well applied to the copper industry as well. A few comments on zinc. Red Dog is still in the top 3 in terms of largest zinc mines. I actually think it's second. We were looking at some numbers last week, but to be conservative, we said third. Its grades have gone down as we moved into Akalik, but there's an awful lot of material up there that's much higher than the current 17 or 18% that we're mining that will decline over time to 15. But we've got a lot of things at 22 to 26% and some large intercepts at 30 plus. So still a lot of zinc up there for many, many years to come. And it's lower quartile on the cost curve. And zinc will have its day one day. Trail is running quite well, having a good year. And we always like to remind people about the greening of Trail, and that from an environmental point of view, even though it is a 100-year-old complex, we've invested a lot over the years, and it really is. It's literally won national gardening competitions twice in the last 6 years, I think, for flowers and gardens, and it's got a smelter right in the center of town. So for those of you who haven't been there recently, it's worth a visit. We're investing in a new acid plant there right now. That'll finish, I think, by the end of Q1 next year. We do have a slag fuming furnace redo upgrade kind of investment that we put on hold during our cutbacks on CapEx, which I would like to finish at some point, but we'll wait to see better zinc prices before we go to that. In terms of the zinc market, I mean, it's a fascinating market because in some ways you never know what's going to happen next in terms of deliveries of so-called hidden stocks. This gives you sort of a 10-year run, and recall that during this period here, for 2 years in a row, in 2006 and 2007, zinc averaged exactly $1.47 a pound for both years, and it did peak at this time at about $2.04 a pound. So it does have potential upside, but of course we have colossal inventory still. But you can see that it's coming down quite steeply. The problem is that there's other stocks outside of the LME that every now and then a big chunk gets delivered, as you see here. And we've seen this happen several times in the last year. Don't know how many more times that can occur. So this is why when I talk about zinc, and we are absolutely convinced that there are going to be substantial deficits in the zinc market sometime in the future, the reality is there's still a lot of inventory to be soaked up. So we're not sure when the price performance will go, but if you look forward to end of 2015, like early 2016, you could have a deficit in the market of several 100,000 tons. And so then what you don't know is how much more hidden stock will show up. One thing that's interesting is just how fast, even though it comes, you get a big jump up like that, how fast that gets absorbed. This is only like a 6-week period that gets down. It seems to take it, and the last one that took us up to 1,070,000 or so, and it's down to about 1,030,000 already. So it does get taken up quite quickly. Other things that complicate, of course, are warehouse issues and how the rules might change there, and some of these things. Big deliveries in zinc are sometimes for odd warehouse-related reasons, and that's kind of a murky area. Now, so this is the first sort of summary slide as we talk about energy, and there's a long list of reasons why we think this is a good fit for us. I mean, as a diversification, there's a bit of a theme going on, has been for the last 6 months or a year or so, where people talk, well, if China's economy is past the early cycle infrastructure spend of growth and moving to more a consumer cycle, that the early cycle stuff is steel related, and that would be iron ore and coking coal, and the next cycle is more copper and oil in terms of they are related to consumers. So from that point of view, I guess it's a diversification of that. I suspect that theory will be replaced by another theory a year or so from now, and people will realize that there's still an awful lot of infrastructure to build with all this urbanization going throughout the rest of the world, and that'll be less relevant. But to the extent that that is a current theme, oil does fit in that. It also, as a commodity, we're not getting into the oil and gas business, by the way. We're not going to be drilling for oil or exploring for oil. This is the mining end of the business that we're talking about. But as a commodity, it does have some other advantages in that it's very liquid, no pun intended, but you can sell forward as much as 15 years. And so to the extent, and you cannot do this with coal. You cannot do it with copper and zinc, and even though there are some long-dated things that you can do in copper, you can't do it in very much volume. But for example, if we wanted to hedge our investment in such a way to ensure getting our capital back, we could buy put options, fairly long dated, and make that part of the business decision. So if we were investing $100, really invest 103 or 104 to give us security what the price would be. We haven't chosen to do that at this stage, even though the project was just sanctioned, but it's the kind of thing that we would look at over time if market conditions were right. At the moment, we have a very strong balance sheet thing, so we haven't done that. But that's some of the advantages related to the commodity. It is in Alberta. Alberta is a great place to do business. If you sit in my seat and you look around the world at the different choices that you have in terms of countries, and I rounded up a number of them before that are quite high risk, and I'm not going to name them again, but Alberta looks great from that point of view. And not just from a geopolitical point of view that they love business there, and they do love the oil sands, so that they want their share, but also from a tax point of view, to the extent that we are investing large amounts of capital in Canada, that creates shelter for cash flow from our 6 coal mines in Highland Valley and Trail and so on in terms of deferring taxes for later, so that's helpful. The business itself is exactly what we do. It's a large shovel truck open pit mine. We have, as I say, 3,000 people who do exactly that within about an hour's drive of the Alberta border, or a little bit more. Lots of skills to draw upon to help on that, and we have a good working relationship with Suncor, and so we'll be able to help each other on that. This is a world-class resource. If you listen to Suncor's conference call last week, and they talk about it being the best undeveloped resource in the industry. But from our point of view, world class again is it's 50 years, and it's a proven resource. We don't have exploration risk associated with it. We're going to get several cycles, and so that'll make a big difference. Long life assets, I've said how important that is, and we've talked about the margins that we literally look at. Our businesses, when we're investing, we could look at copper at $3.25 copper, roughly where it is today, versus something at $1.25 cash costs, or oil, where after you start at WTI 95, you end up netbacks of $60 versus $25. So the margins are about the same. Long life, good geopolitical and same skills, and with a little bit probably more diversified customer base. So you could look at zinc, a zinc operation where you have $1 zinc price and 40 cents cash cost. You could look at any other commodity and say, well, what's the margin, what's the mine life, what's the geopolitical risk, what's the environmental and geo risk kind of stuff, and in a sense just allocate your capital to where the best margins are. And in terms of execution risk, there's no question we're relying a lot on Suncor. One of the things that they were highlighting in their presentation, and they wanted me to highlight as well, is that they've just completed $20 billion worth of projects in the last 4 years. Every single one of them came in under budget and on time. And they have scoped out and designed and engineered Fort Hills to be the same. They delayed it a year basically to sort of get it right from that point of view. So we are counting on them. We're well aware that the industry has had blowouts over the years, and so I guess we'll just have to see how that goes. But they're very specific on the ways that they're going to handle it. And one of the key things that I like is that they're not going to be throwing 10 or 12,000 people at it just to try and get it done, because that's when your labor productivity really gets hurt. They're going to max out at 5,500, I think, and in a sense they'd rather take their time than to have the capital blowout, and so would we. And you'll hear more about that. Now, there's a slide here that I don't think is in your books that I want to talk about, because we had a lot of questions about IRR and NAV, and we don't publish a number. They publish 13%. I've said it's double digit, and we've seen a number of reports coming out saying it's between 10 and 12%. There's two things I wanted to talk about. One is how the NPV works. Like, by definition, on the day we announce the decision, the NPV is the lowest it's going to be, because the next 4 years is nothing but capital out, and then you have commissioning and startup, and the capital doesn't come in for a while. But as each year we get closer, if you do the NPV a year from now, there's capital that's behind you that you've put into the project, and there's less capital outflow ahead of you, and you're closer to when the capital comes back in. And what you see here in the red line is just how fast that goes up. And so, and this is where we are. 4 years before production, there's production. So at the point at which it starts up, the maximum NPV is probably a year or a bit after that, once you get full cash flow. But this would do, you're going to have a project that's worth, well over $20 billion at that point. And then the difference between, and then you get your capital recovery, and say if we're building in an 8-year payback on a 50-year mine life, that we're going to have a mine life to payback ratio of 6 times. We normally like to target 3, and we're really happy we get 4. In this case, we get 6. So this long life in a good geopolitical jurisdiction is a very big deal. But then here's the other thing, that if you have a 50-year life, you don't get the same decline as a 20-year life. That in terms of building a company, which is my job is in terms of allocating capital, to have a long life asset, you're going to have that value. You've got all your capital back, and you've still got the value. And so if you have a longer term investment horizon, as I do, and as Dr. Keevil and his family do, and Sumitomo does, and CIC does, then this is a good way to build a company and build shareholder value. The last point I would make on the IRR debate, that again, when you're looking for alternatives for your capital, it may be that you can find a higher IRR than 12%, but the odds are quite high that will be a short life. That you may find something that is 15 or 18%, and it's 3 years to 8 years. And so then what is your choice? Do you want to do something like that where your model says that you've got an 18% IRR for 8 years, but you did that based on commodity assumptions. And if during the 8 years, you get a couple of bad years, it doesn't work. Whereas this is 12% for 50 years. Warren Buffett's laws of compounding numbers and stuff, you apply those principles. This is the kind of thing that really creates long-term value. And so I go back to what I've always said, we can do all the calculations we want, and we know for sure that the answer is wrong. But in terms of allocating capital someplace that's going to sustain the company for generations at a pretty high rate of return, maybe not 20, but 12 is pretty good. And this is after-tax real rate of return. And our weighted average cost of capital, according to Price Waterhouse, is 6.8%. I actually think we're going to get double our WACC on this over a long 50-year period. So these were just some additional thoughts, because I know that's, for most of you, that's a key part of your job. You've got to run some numbers and publish, and but then you have to step back and say, well, what kind of choices did they have for allocating the capital, and is this one going to pay off in the long term? It's definitely not a quick short-term investment decision. A couple of comments on gold, because while it's small within the portfolio of Teck, we do want to start highlighting it, because some time ago we recreated Teck Gold. It actually has its own brand, its own management team, its own internal board of directors. We meet quarterly, and we give them $20 million a year as if they're a junior gold company. And then if they want more, they have to come back to the board with the actual investment proposal that they might have. And their objective is to build something that's worth $1 billion that we could sell again. We sold our last gold portfolio for roughly $1 billion in 2009. Now, our strategy in gold has been for some time based on the historical fact where for 30 years, gold companies tended to trade at much higher valuation multiples than a diversified metals producer, and sometimes as much as 3 times NAV. Certainly, whereas a diversified company tends to trade between 0.7 times NAV and 1.3 times NAV, depending upon where it is in the cycle. So it made sense to us to use our geologists, 150 exploration geologists or so around the world, dealing with juniors, looking at their own grassroots properties to find the gold, take it to resource and reserve, engineers take it to pre-feasibility and feasibility, and then sell and capture that value to gold companies that are normally challenged with short life operations. They're always on a treadmill trying to replace, and they'll pay for it. That has been the strategy. The interesting thing is, since the creation of the gold ETF and its enormous growth until this last year, That sucked a lot of capital out of the gold equities and has reduced valuations, so that at times some of the gold companies have traded actually at lower NAV multiples than we have. So this is new. This is a big difference. So people have asked, well, would you go into gold and actually, if you found something, build it or actually buy it? Because there are situations where we look at it, we say, well, we could buy that and it would lower NAV than where we're trading or has decent cash flow. The key issue, again, comes down to mine life. That and gold's also much more difficult to sort of come to a conclusion on price. At least in copper and zinc and coal, we can look at the cost curve, we can look at general growth rates, and we can know it's going to come clean at some point. With gold, actually, you don't know, right? It's a much more unpredictable asset. But we are looking at it to see if there are other opportunities. I wouldn't anybody go out and write a report saying Teck's getting into gold. That would not be accurate. But we do have this small portfolio. Well, it's not that small. We've got 60 different royalties in it, believe it or not. So we could spin out a royalty company if we wanted. Watch out, Silver Wheaton. We have a lot of grassroots properties with some exciting things in Turkey, as you've probably heard about. So I would say these guys are well on the way to building the $1 billion of value that we could then choose to do something with at some point. They have independent financial statements. They get independent appraisals every year as we monitor their progress towards their goal. So I'm just about wrapping up here. We are very conscious that people are looking for returns, not just in market value, much of which we don't have any control over because it's driven by commodity prices and the battle we're seeing between Australia and the U.S. in the coal business, or people's perception of growth in the U.S. or China or Western Europe. And actually, just since I strayed onto that, I'd make the observation that versus a year ago when we were here, each of the 4 major economies that drive consumption of commodities are in much better shape today than they were a year ago. And if you start in China a year ago, you hadn't quite had the leadership transition yet. Today, they have leaderships that are very strongly in place with strong policies and very experienced and committed to urbanization and growth, and we have a lot more comfort of what's going on there now. In Japan, we have Abenomics we didn't have, and I think that's going to have a really big effect on the long term. The U.S., notwithstanding, it's had the whatever you call what happened in Congress, and a few challenges, but you've had incredible auto sales, and the general underlying level of confidence is better than it was a year ago. Housing has its ups and downs, but it's generally better. And so I think that the entrepreneurial energy that has always sustained that economy has demonstrated itself to still be there, and that over the next 2 or 3 years you'll see continued progress. And the deficit numbers have come down. And then in Western Europe, they had a quarter of growth. And even Spain seems to be coming back. So versus where it was a year ago, it too is in better shape. So I generally think the outlook for global economy is better today than it was a year ago. But this slide is all about returns to shareholders. In addition to market value, whatever it might be from a commodity price point of view, we are delivering. We've got our costs under control, our capital under control, record coal sales, as you see, so good, strong relationships with customers, the logistics chain is working, all that. The company's running really well. I hope you'll take that conclusion from the next presentations. But we can't control the commodity price. But we can always be committed to providing returns to shareholders through dividends and buybacks. This shows that we have been raising our dividend. I'll just be clear again on what the policy is. We have a very clear policy. We don't necessarily raise a dividend every year based on the following factors. First, there are 2 approaches to dividends in the mining business or in commodities business. One approach, which is done by a number of companies listed in London, is they have a base level dividend and then they top up depending upon whether the commodity prices were high that year or not, or what the financial performance was. The other is a more progressive dividend policy where it's more related as you add productive capacity and have the ability to increase the dividend on a sustainable basis, you do that. And that tends to be the more North American approach. Our board has adopted the North American approach. We have a lot of U.S. shareholders, as you know, and so that is our policy. So we will look to increase it in line with a growing company, Doesn't mean every year, but it has the last 3 years. And that will generally be looked at in the November board meeting or about the same time as the third quarter results. As we look at it, big factors that we will consider is what capital requirements do we have coming? And so obviously we have Fort Hills, which has now been sanctioned. That's big CapEx, and we have Quintet that we're still thinking about. And then down the road, there's QB2, quite a ways down the road now, unfortunately. But all these things will be considered by the board, and also they will consider dividend signaling theory as to whether, if you raise your dividend, is that saying that you believe that the coal price is about to jump to 200, or that, these kind of things that people often overinterpret your actions. So it's a balance. I can't tell you what will happen this year. It could go either way depending on which way you want to argue. We obviously have the money. It's not a question of do we have the cash? We do, but we do have big CapEx ahead of us as well. In terms of buybacks, in terms of special dividends, highly unlikely for two reasons. Because first, they're double taxed in the U.S., so not a tax efficient way of returning capital. But second, and more important, if you want to build a successful mining company, which by definition has assets or resources that deplete and require large capital to acquire or build, just handing back all your capital through a special dividend is a difficult way to grow the company. And we aren't of the philosophy of shrinking the company to maximize short-term returns. That stuff, I mean, that's Dr. Keevel's been involved in the company for 50 years, his father before him, and they want the company to be around for a long time. So special dividends, highly unlikely. Likewise, on buybacks, a tender offer for a very large buyback, even though it can be very tempting, the numbers can look very appealing, and believe me, I know. I bought a lot of shares for cash. I think that way, and I get very tempted saying this is the best return of my capital sometimes. But it's highly unlikely for the same reasons that I just outlined on the special dividend. But having said that, I do have approval from the board to do a normal course issuer bid every year, and we just bought back 10 million shares in the last one. We bought 5 million shares back in the one before. We filed for up to 20 million shares this year so that we have the capability. That does not mean that we will buy back 20 million shares, but we will buy back some, because I want to make sure that when I look at a 10-year summary in the annual report of, where we show all the different factors, and usually the bottom line is how many shares are outstanding, I want to see that going down a little bit each year. Now that we do have options, most of which are out of the money right now, so we won't be diluted that way, but to the extent that we do have options, we'll buy back more shares than those options. So we bought back 15 million shares in the not too distant past, and we will buy back more in the future, but opportunistically when we think it's appropriate. So that's the policy on that. So in conclusion, commodity prices may be down, but volumes are strong. 7.6 million tons last quarter of sales, more than we produced by quite a margin, and a good range of customer interest. So that should be a very important point for it. Cost reductions are on track. We originally announced 200 million. We're now going to hit 330 million, and some of that still needs to flow in. But I think you can do the numbers and already see that it's making a difference. We are very tight on our CapEx schedule. We're watching future cash flows. $30 in the coal price would make an extraordinary difference. On 28 million tons, that's a lot of cash. But as it's bouncing around in the 145 to 155 range right now, we're going to be very careful. Balance sheet is very strong. Our cash levels are actually going up now, and we have very little debt due in the next 3 or 4 years. 323 million. In total due between now and the beginning of 2017, and we're sitting on billions in cash. So we're in good position, which could allow us to do something more than just the Fort Hills announcement that we've made. And with that, I'd like to open it up to questions. Am I way over time already? I'm sorry about that.
Just a little bit, yeah. Is this mic on? Thanks. We do have a few minutes for questions, and I would like to remind you that this is being webcast or being taped for webcast, so we're going to ask you to wait till the mic gets to you to have your question recorded, and then we'll proceed that way. Thanks very much. Ray, Lori's coming with a mic here.
Just a quick one, Don. The inventories you showed for zinc, were they just the LME inventories?
Yes.
My question, Don, is more strategic in nature. We've recently seen the news on the Pascua-Lama project getting suspended in Chile. You've gone back to the drawing board on QB. So I just was wondering what your take is as to where we are in the kind of grand scheme of resource nationalism / geopolitical risk. Do you think we're kind of reaching a zenith here, and that some of the countries that are essentially rejecting capital now may be rethinking that? Or do you think that it's just par for the course going forward, and that ultimately could be a support to commodity prices because projects will just be much more costly and much more risky to do everywhere in the world?
So that is an excellent question. That is the core issue in the industry today. I could talk about it for hours. I'm going to break down my answer into 2 or 3 parts. The first on the resource nationalism part of it, and I'm going to tell a bit of a story just to sort of make a point. At the World Economic Forum in Davos in January, there's what they call the Governors Forum on Mining and Metals, and the membership has changed quite a bit in the last year. So myself and Ivan Glassenberg are the only 2 that have been there for a while, and then there's all other new members. And last January they had 4 heads of state come in to see us. Maybe not heads of state, but either prime ministers or presidents, and sometimes there's a prime minister that's sort of the number 2 guy. But from each of Peru, Zambia, Mongolia, and not South Africa, Guinea. They were there, I believe, with the mindset of resource nationalism at its peak, when they pound the table and they want 50% of the metal value in the ground and some very huge numbers in those kind of speeches. And what they got back from our group, you had some, Klaus Kleinfeld was chairing it because Tom Albanese had supposed to be, and he was gone the week before. And so he acted as the chair and tried to keep the rest of us from sort of jumping out of our seats at these country leaders. But one guy that he couldn't keep from jumping out of his seat was Ivan. And Ivan started to lay into these guys, and I know he will appreciate me saying it. He and I have talked about this a lot. We're good friends, and he started to like really go after him and say, "Who do you guys think you are? Don't you know the cycle's gone? Like you've taxed yourself out. We're never going to your countries. We're not going to stuff." And then when he stopped to take a breath, and Klaus was trying to calm down, he'd start again. And at the end of it, the guy from Guinea, who's quite intelligent, he used to be professor at Sorbonne, and he sort of put us, well, what are we to do? You know, and they're trying to attract this investment. Never got off the ground in Guinea, and big billions of dollars have been spent, and they aren't getting any resource revenue. And my point of telling that story is that I think the message has gotten across because they've seen investment decline enormously. And so we've now seen a change. Several countries have changed their tax regimes, and if they haven't changed, they've consulted with us and literally requested meetings. I've had some interesting ones in that category where they ask, where is the balance, where is the sweet spot that will attract investment? How do we demonstrate stability? And so I think the mindset has changed. At the ICMM meetings 3 weeks ago, when the top 15 CEOs sat together, we changed our priorities for the coming year from where resource nationalism was sort of the biggest thing we worried about, to now we're less worried about that and more worried about what we described as community acceptance. And community acceptance is more local, still in coordination with federal and provincial or state governments, but that's become the more difficult challenge, and whether it's the news on El Moro this morning, or whether it's things we face we could face right in BC. We have communities that we have to be very, very careful about what their wishes are and make sure they're fully consulted, and that's going to be an ongoing challenge. And I think the cost to that may be just as great as what resource nationalism was. Resource nationalism was an actual cost in percent, if you like, in terms of your cash flow, whereas the cost of community acceptance is time, and the time value of money. Now I'm leading into the second part of your question. You know, on QB2, we're going to lose probably 3 full years because Chile's changing the rules, and during that phase when the rules are being changed, the regulators don't quite know how to apply it, and so everything just slows down, and you have to go back and redo different parts of your SCIA, and you may have to do new surveys in the field, and it's all unpredictable. The timeline is completely unpredictable. Well, that has a cost, not just time value of money, but has a cost in capital. Now, if that was in the period from 2005 to 2011, there'd be a really significant cost and like increase in your capital cost. Today, I'm not so sure. We've done updates on QB, not so thorough that we'd publish them, but we will at some point. But it hasn't increased as much as you'd expect. The labor component always increases, but it doesn't necessarily always increase at 15% as it was for several years there. Maybe it gets down to more like what we're used to in Canada of 3 or 4% that we have with our unions. But equipment costs are coming down, and sometimes you know, a reasonable amount, but it won't happen forever. You know, eventually capital spending will return. So we're in kind of an odd phase, and most companies that have new CEOs, they all have the same mandate, you know, cut costs, sweat the assets, sell your non-performers, and don't go anywhere near growth. And I think that's fantastic. You know, I want them all to keep doing that as long as they can. Because if they do that, then for us to build QB when and if the day comes, you know, then equipment will not have, you know, there won't be that much competition. We'll get good deals. And also global growth does continue relentlessly at 2 or 3% a year, and that means that demand will exceed supply again. And as we all know, you can't turn on a mine like you can turn on oil. And you know, whether it's copper or zinc or whatever it might be, we'll see some real shortages then. The problem is you have to lead that. Your investment has to be ahead of that to be able to be in production when that occurs. So those are kind of the issues that we struggle with. I'm not sure that's a very clear answer to your question, but that's how we think about it and how we're watching it. And there have been, as I said, some shifts from resource nationalism, less so, community acceptance, more so. That's probably the main answer. Greg, over here.
Don, I think it's fair to say that the copper business has kind of run into a lull for the next 4 or 5 years around that 400,000 tons. Do you anticipate doing anything to grow that business in between now and whenever QB2 happens?
Yeah, and I'd say the lull is more around 350. It is high on our priority list. We have looked at a number of alternatives. I would have told you a year ago that we had the team go through, I think it was Ron or Colin might remind me, 470 different copper opportunities around the world, and we categorized them all into A, B, and C, which ones were going to go for sure, which ones, you know, had 1 or 2 things wrong with them, which ones looked unlikely. And we narrowed it down to, I think, 4 actionable acquisition opportunities that we could make. But even when you look at them, each one of them had issues that made it not ideal, and rightly or wrongly, we didn't act on any of those. Now, more opportunities keep coming up. I mean, just last week, another opportunity surfaced that we wouldn't have thought would. So you think you've looked at everything, and then you realize something else new comes up. So as they come up, we will continue to look at them. It is high on our priority list to continue to grow the copper business. We have a very constructive view on the copper market and copper price medium to long term. I think most people think there'll be a surplus in the next year or two, and there could be some weakness, though the price continues to perform pretty well. It hasn't, you know, we might have thought it'd be down to 275 by now, but it never seems to get there. So that demonstrates that there should be decent upside later on. If you go out to the year 2020, there's potentially a significant gap measured in millions of tons of shortfall. So yeah, an investment in copper would be a good fit, but we haven't found anything just yet.
Hi, Don. In light of the high capital intensity to build these large, long-life assets, where do QB2 and Frontier, or more importantly, maybe copper versus oil, sit in your, relative ranking? You just talked about the good long-term outlook for copper. Do you feel equal in oil? And maybe another way to ask it, if you go ahead and build Frontier as well as Fort Hills, you can conceivably see a point in time in the future where oil is 30-40% of your income. Is there a level where you'd like to see that cap out or stay below?
Okay, I think there were 2 or 3 questions within that. I'll just work backwards. We don't want to get overexposed to oil as a commodity or to anyone. Like I don't really like having something being 50% of our operating income right now, which or revenues, if you like, and then you literally only trade as a coal company right now, and that makes me a bit uncomfortable. We like diversification more. So even though we'll be investing a lot in the energy sector, there is a balance there somewhere. In terms of outlook, I mean, one of the things about oil that I'm not sure people pay that much attention to is the depletion rates. And I was talking to a good friend of mine who's a senior oil trader at Goldman. He and I went to business school together. He's Canadian. And he was talking about when he started in the business at the same time, as I started in this business, I think global production was 55 million barrels a day and depletion rates were 1 or 2%. Well, today it's 6%. And so on 85 million barrels a day, if you apply 6% as a factor, it's 6% in a lot of places. I don't know what the worldwide rate is, but you need to come up with like a whole North Sea of production every year just to stay even. And he looks at what's happening in Saudi Arabia, who are now very concerned that the U.S. doesn't need them anymore, and they have their 10.3 million barrels a day of capacity. They're not investing for more, and if they have that depletion rate of 6%, which I think they do, it's going to shrink. And so he sees, that the chances of quite a significant squeeze coming in the next 2 to 3 years are quite high. And he'd go buy Suncor, because that would be kind of the thing to do. So I think, notwithstanding what the developments in tight oil in the U.S. and shale gas and energy generally in the U.S., a lot of those things have very high depletion, 50% sometimes. And I think that when you go past 2018, you don't really know whether it's sustainable, and a lot of people think it won't be, and then the costs are quite high as well. So you actually have a cost curve in oil that has the same kind of stuff as I was talking about in copper. So we think it has some good factors involved, but we're not saying it's the best, or I think it's just going to be steady. The world's going to still need oil. Versus copper, when you look at them side by side and do a margin analysis, geopolitical risk analysis, if they both have 50 years sort of thing, then in a way I could make myself agnostic between the two and just look at what's the best margin, what's the best return, where am I most comfortable with the technology or the workforce or the NGO position and that sort of thing. So I don't think there's that much to choose between them. It's all about making money and what's the highest return, risk adjusted return.